Well, let's start chapter 11. Actually, one of my favorite chapters. I really enjoyed this chapter. It makes a lot of sense, I think, and it's really helpful for anybody who is involved in projects where you work and trying to help the company decide what project should we do? How do we figure this out? So capital budgeting, just the word itself, capital budgeting is how do we pay for and what's the rate of return on big things that we do? Okay, so if we're going to choose to buy some expensive equipment, build a new building, launch a new product line, expansions. There's all kinds of examples of projects out there. And the book does a really good job of laying out several examples of projects that a company could choose from. There's lots of ways to figure out the answer. What project should we take on? What's our rate of return for the project? Things like that. And we'll go through all of them. So the first one, or the background I should say, there we go, is just what is capital budgeting, and basically just analyzing the potential addition of fixed assets. They're very long-term decisions, right? When we buy a fixed asset, we expect that fixed asset to be around for quite a while. Long-term decisions involving large expenditures, so lots of money, very long-term. Very important to the firm's value. Will this addition add value to my firm? If I do this, will we go up in value? And that's really what all finance managers are trying to figure out, right? We should always be making decisions that add value to the firm, because if I do that, my stock price goes up, I can pay more dividends, shareholders are happy. So there's several steps to get this done. We're going to talk a lot about cash flows. So CF is cash flows. Estimate cash flows, both inflows and outflows, right? Quite often there's a large cash outflow as we pay for this capital expenditure. Then hopefully the cash inflows then are positive over a long period of time that will more than be much larger than the outflows. Assess the riskiness of the cash flows, and the challenging part with capital budgeting is we're guessing the future, right? We know generally what the outflows are initially. We know, we can get estimates and costs and invoices and bids and contracts to say, here's what the cost is up front. If we're going to build this thing or buy this thing, here's the cost. The hard part, though, is what are the future cash flows that hopefully are positive, because we're guessing the future. So that's what makes a lot of this very challenging. And of course, the harder it is to compute those future cash flows means there's some more risk then, right? So if something's very certain, is contractually obligated, there's not as much risk. If there is just a whole bunch of uncertainty, there's a lot of risk. My example when I did a lot of these was when I was in property management for a couple of years in construction, is as we thought about building a new building somewhere, and quite often it was apartment buildings. It's you go through that process of identifying the location, drawing up plans, getting those approved, and once you get all that done, now what's this going to cost? So bidding it out to construction companies and saying, here's what we want to do, what will this cost? And then once we have the bid of knowing the cost is, okay, how many units is that? What's the price per unit? How long will it take us to rent this up and fill it? How full will it be? Will we get 80%, 90%, 100% capacity? How long will that take? And then cash flow the property out and basically say, what will how much cash will be coming in versus paying off the debt, paying back anybody who invested in the property, giving them a return, and just paying for the operating costs of the property itself, the property management, utilities, all the things you need just to maintain a property. But you're guessing a lot of things. You're guessing what we can charge as rent, even that amount. That's the market bears some of that. You have to predict the future market. You have to predict how long it takes to rent the property up. How sustainable is that? Will it be a very popular property that people want to get into? Will you have to discount the price to attract people? All things come into play, but that's part of the analysis that anybody in finance who's projecting those kind of things has to go through. So that's kind of what we're doing, is we're determining future cash flows, and by doing a lot of hopefully educated guesses. So once we do that, determine the appropriate cost of capital. And there's a reason this chapter is right after the WACC chapter, is because we need the WACC to help us compute the capital budgeting process, right? And again, we talked about in the previous chapter, in chapter 10, that when we compute the WACC for our company, that's an average WACC. That takes into account all the risk of our company, both for risky projects and safer projects. And that's an average number. So we might have to say if this new project has a lot of risk in it, I need to adjust my WACC for more risk, and therefore that will impact the decision that I make. Find the NPV, net present value, and or the IRR, internal rate of return. So those are a couple of the different methods that we will use to compute capital budgeting. We'll accept a project if the net present value is greater than 0 and or the internal rate of return is greater than the WACC. Okay, so we want to clear the hurdle rate, right? The hurdle rate is that rate of return that we need. So if we compute a WACC of 11 and I do my analysis and determine this project will get a return of above 11, I would say yes. Okay, so that's kind of just the basics of what we're trying to figure out in this chapter. So as we look at projects, we have to determine, are they independent or mutually exclusive? Okay, so independent projects means the cash flow of one are unaffected by the acceptance of another, or mutually exclusive means if the cash flows of one can be adversely impacted by the acceptance of another. Some retailers, restaurants, just think of any franchise type of a business. When they come into a town and build an initial location, that's all fine and good, and usually what happens then is that location begins to do very well. It's maxed out on capacity, so you add a new location. Well, you know that once you add a new location, you're going to negatively impact the sales at your existing location. It's just the way it works, but you hope that by adding 2 locations that ultimately over a longer period of time you essentially will double your sales at some point in time. So it's kind of like that. Or another example would be, let's just say we have some kind of a factory and we need a better way to move parts through our factory as we assemble and make some kind of a product. And we can go with forklifts or we can go with some kind of conveyor belt system. Well, you wouldn't choose both, right? That'd be mutually exclusive because I only need one way to move parts through my factory. It's either forklifts or conveyor belts, but not both. So I would just choose one versus the other after I do an analysis and figure out which one would be the best one for me. So, but sometimes you have independent projects, sometimes you have mutually exclusive, just something to consider and think about. So then we're going to talk about the difference between a normal and non-normal cash flow streams. A normal cash flow stream, you have a cost, which is negative, followed by a series of positive cash flows with one change of sign. So the normal way is you spend a whole bunch of money to buy something or build something. Then once it's built or you own it, you begin to use it to earn future cash flows. So one of the apartment complexes that was built when I was in property management construction cost us $4 million. So you had a negative cash flow of $4 million to pay for the building of the property. And then once it was online, it was completely built. Now you have a whole bunch of positive cash flows as you lease the property and people pay you rent. Okay, that's normal. Non-normal cash flows, 2 or more changes in signs. Most common is you have the initial negative cash outflow to build or buy the project, a string of positives, and then a big negative at the end to close out the project. So this deals more with probably energy in terms of if you're mining something, an oil rig, anything like that. So basically to get the permitting to be allowed to do what you want to do, quite often you have to set money aside in trust with the government or in some kind of secured account that is set aside then to decommission a power plant or put the mine back together again, restore everything back to its original state of being. Okay, so there's lots of ways to do this. The first method is the net present value method, the NPV method. The sum of the PVs of all cash inflows and outflows of a project. Okay, so the sum of present values of all cash in and all cash out. Now that's a big ugly formula, and whenever you see the funky math science, it gets a little weird, right? So we're all like thinking, oh, I don't know if I can do this, but guess what? Excel does it for us. That's the best news. So I will show you that in a separate recording, how Excel can do some net present value calculations for us. So basically the theory behind it is all the cash flows divided by 1 plus the required rate of return, and the T stands for time, and the sigma here is the number of periods. Okay, so basically that's net present value. So Excel will do that magic for us. So just some examples then of a couple different projects. Long and short, L and S are the two projects we'll look at. And you can see that both of them have an initial cash outflow of 100, and then they have a series of positive cash flows after that. And you can see for L, it's a small positive in year 1, then bigger positives in years 2 and 3. And for S, we get a big return right away, then that kind of just begins to decline. But either way, we get a series of positives. And it says the change in cash flow at delta, the triangle, change in cash flow, is basically what's the difference between the two projects over time. Okay, so change CF is the difference between the cash flow L and cash flow S. We'll use that number later. So what is the project's net present value? And they're giving us the WACC. They just say it's this number. In Applia, occasionally in this chapter, you may be asked to compute the WACC for a project. We know how to do that now because we did that in chapter 10. And so you can see here in year 0 today we spend $100, and then in years 1, 2, and 3 we've got these positive cash flows. And essentially what we're doing is we're bringing down the present value of those down to today. And so the NPV is the net present value, right? So a negative 100 today plus the positive future cash flows. 10 at 10% discounted at 1 year, 60 at 10% 2 years, 80 at 10% for 3 years is the present value of those 3 cash flows, and the net present value is $18.79. Okay. So quite typically then, that CF0 is negative. Okay, that's what it is here. And then basically the NPV is the rate and all those future cash flows at a present value. Okay, the rate is the WACC. So Excel will do this for us quite easily. So Excel, this little formula in Excel, is doing this formula right here. Okay, and the model with, and this is for Project L, the model decision to make with NPV is as long as it's above 0, it's positive, the answer would be yes, we would do this project. Okay. Now we look at Project S and it has a higher NPV, and the reason it has a higher NPV is its cash flow right away was large, right? We got that initial 70, then it went down, whereas for Project L, it was the other way around. The big payback, we had to wait 3 years to get the big number. With S, we get it right away. So the NPV for S is larger because the 70 we get right away. It's only discounted at 1 year, not 2 or 3 years where it'd be lower. So again, it's positive 1998. Okay. Now, of course, we can do that in a financial calculator if we wanted to. You can just have to enter your series of cash flows by using the CFLO register on your calculator, or again, just use the Excel, which I think is by far the easiest because you can see all of your inputs are just sitting right there in the cells of your Excel file. So, rationale for the NPV method. NPV is the present value of inflows are hopefully greater than your cost. So present value of all inflows minus cost equals your net gain in wealth. Okay. If projects are independent, accept the project that has the NPV of greater than 0. So, if both those projects were independent and I had the resource to do both, I'd do both for L and S because, they both are a nice positive number. But if they're mutually exclusive, then I would go with the one that gives me the highest NPV and adds the most value, which is S. So if it's mutually exclusive, I'd go with S because S had a higher NPV than L did. Okay, but if I could do both, they're independent projects, and I could afford to do both, I would do both. Okay, so that was the NPV method, kind of the gold standard, the one that's used probably the most. I will tell you that when I was doing this in industry, we did all these methods, And the reason you did them all was just to make sure that you were consistently choosing the right thing. You just kind of felt better about making a choice when you basically all the models came back and said, yes, do this project. It's going to work out for you. So it's really not unusual for a company to use all of them. But IRR is the next most popular one, internal rate of return. And this one computes an interest rate, literally a rate of return. So NPV, we got a number, and then if the number was above 0, yes, we'll do the project. This one is an interest rate. So the IRR is a discount rate that forces the present value of inflows equal to cost and the NPV to 0. So whatever interest rate that will force NPV to 0 is my internal rate of return. Solving for IRR with a financial calculator, it shows us how to do that, or I can use Excel. Okay, I can use Excel. So if I use Excel, I get IRR CF0, cash flow today, and then cash flow N, and guess for the rate. And I'll show you how to do that in the chapter Excel file that came with chapter 11. I'll show you how to use that. So IRR is whatever interest rate that forces NPV to 0, basically saying if we hit this rate, the NPV of the project will be 0, and then once I get that rate, as long as that rate is above my WACC, then I'm good to go. So here, how is a project's IRR similar to a bond's yield to maturity? Basically, they are the same thing. Okay, it says think of a bond as a project. The yield to maturity in the bond would be the IRR of the bond project. So it says suppose a 10-year bond, 9% coupon, and this is annual. 1,000 par sells for 1,134.20. IRR and the YTM are the same thing, the annual rate of return on the project. So if the IRR is greater than the WACC, the project's return exceeds the cost, and there's some return left over to boost stockholders' returns. Okay, so if IRR is greater than the WACC, accept. If IRR is less than the WACC, reject. If projects are independent, accept both projects as both have an IRR above 10, and they basically, for the two projects, for L, I kind of skipped over that. For L, it was 18.13, and for S, it was 23.56. I kind of skipped over that part. Did not mean to do that. But remember that our WACC was 10%. They both have a rate of return well above 10%, and that's what you want. So you would choose S if they are mutually exclusive. You would choose both if they're independent, and you could afford to do both. Okay, so that's what they're saying down here. I'm not going to really cover the NPV profiles too much here with you. The graphical representation of NPVs at different costs of capital, just know that what this is doing is basically just saying at what point would you not necessarily include a project or accept a project, I should say. So in this range up here, we would accept. At this point down here, we would reject. And they're kind of just telling us the same thing here with mutually exclusive projects. At what point would you pick one versus the other? And I'm going to skip the crossover rate, and I'm going to skip that part too. So I'm not going to really get you too much work on that in Applia, just so you know. Okay, so now the next method will be the modified internal rate of return. And before we talk about that, we kind of have to set up a little bit of an issue here. So the NPV method assumes cash flows are reinvested at the WACC. IRR method assumes that cash flows are reinvested at the IRR, the internal rate of return. Assuming that cash flows are reinvested at the opportunity cost of capital is more realistic, so the NPV method is the best. NPV method should be used to choose between mutually exclusive projects. It says at the last point, perhaps a hybrid of the IRR method that assumes cost of capital reinvestment is needed. So let me just step back and just kind of point that out again. So when I calculate NPV, it assumes that all future cash flows are reinvested in my company at the WACC rate of return. So this company that we're looking at here is 10%. When I calculate IRR, it assumes that all cash received from the project are reinvested at the IRR rate, which actually is not very realistic. Okay, that's not how things really work. So that's why NPV is the gold standard and the one that most companies will use. You still do the IRR just to make sure that yes, it still makes sense to do the project. More information is good, but IRR kind of has an unrealistic return in it. And so there's what they call the modified IRR, which takes that into account. So MIRR, modified internal rate of return, is a discount rate that causes the PV of a project's terminal value to equal the present value of the cost. Terminal value is found by compounding inflows at the WACC. MIRR assumes that cash flows are reinvested at the WACC, which is a very realistic assumption, much more realistic than IRR. Okay, so terminal value, remember what that means. Terminal value is basically the compounding of all cash inflows at the WACC. Okay, so compounding cash inflows at the WACC. And the next picture right here I think gives you a really good example of what that means. Okay, so I'm going to the right. Think of it that way. So look what I'm doing here. I've got my initial cash outflow of the 100, and I've got my three inflows, the 10, the 60, and the 80. And I'm compounding all of them forward at the WACC. Okay, so I go, what's my and the 80 is the 80. The $80, it's at the terminal. Year 3 is the terminal year. The 80 is the 80. I don't do anything with it. But I take the 60 and I compound it forward one period, so it becomes 66. And I compound the 10 forward at 2 periods, so it becomes 12.1. So the terminal value of my project is the 80, the 66, and the 12.1, which is 158.1. And then what I do is I use my MIRR formula, and I say $100 equals the terminal value of 158.1 divided by 1 plus the MIRR at the power of 3 because it's 3 years. And I get 16.5. Okay? So thankfully Excel will do that for us, just like Excel will do almost all these things for us, which is great. And so in Excel, we'd use an MIRR formula, and it would say the cash flow today of 100, and then we take in the cash flow N, number of years, the finance rate, the reinvestment rate. Okay? And we'll get that number. So we assume that both rates equal the WACC. And it says here, these rates are the WACC. Okay? The WACC, your 10%. So why use MIRR versus IRR? MIRR assumes a reinvestment at the opportunity cost of capital, which is the WACC, which is realistic. MIRR also avoids the multiple IRR problem, which I kind of glanced. I didn't really cover that. Managers like rate of return comparisons, and MIRR is a better comparison than IRR. Okay, so while IRR is very easy to use and it makes sense to use it, MIRR is a better measurement. So you put more weight on making a decision with MIRR. Okay, so there's just two methods left. We went through the hard ones, believe it or not. Those are the hard ones. So the easier ones are payback and modified payback. So payback is basically just the number of years required to recover a project's cost. Basically the question of how long does it take to get our money back, which everybody seems to ask. When I do cash flow modeling on a new apartment complex, the number one question I get from the bank, from the owner, from the potential investors is, how long before we get our money back? Basically, how long before the future cash inflows of the project are greater than the initial cost? How many years will that be? And you don't make a decision based on that necessarily, but it's just good to know. And people can make sense of that number very easily. So it's just an easy to understand number. While we probably shouldn't use that number very often to make a decision, it's just good information to have. Knowledge is power. We calculate this by adding a project's cash inflows to its initial cost until the cumulative cash flow for the project turns positive. At what point in time will it be positive? So calculating payback, we're using the same example as before. We've got our two examples here. This is for Project L, the longer one. So I spend $100. In year 1 I get 10, so it's still at negative 90. In year 2 I get 60, so it's at negative 30. But in year 3 it goes positive, so my payback is something between 2 and 3. Okay, it's somewhere in here. it's 2 point something, okay? Because in year 3 I go positive by 50. So I know it's 2 plus something. It's 2 point something. So it's 2 plus 30 divided by 80. And I get 2.375 years. I can do the exact same thing for S, and it's 1.6 years. Because remember, Project S, we had some big cash flows right away. Then they went smaller. This one starts small, gets bigger. So it's a little bit opposite. So 2.375 for this one, L, and for S it was 1.6. So how long will it take for the project to go positive? Okay. Now, the one drawback of this method is it does not take into consideration time value of money. We give every future year a positive weighting as anything early. Okay. So no time value of money is involved, and that's unrealistic. So one way to get around that is to do the discounted payback, which does use the time value of money. So this is the cash flow is just the normal cash flows. PV of the cash flows then is the present value of each of these cash flows discounted at the WACC, adjusted for the number of years. So now it's still going to go positive between years 2 and 3 because basically it's 18.79 cumulative. It's going to go positive between these 2 years. It's just going to take longer now, 2.7 versus what it was here of 2.375. Okay, so you always have it'll take longer with the discounted payback to go positive than it will for just straight payback. So I kind of mentioned a couple of these already, but the strengths are indicates risk and liquidity, easy to calculate and understand. I mentioned both of those. It's very easy to compute the risk and liquidity and easy to understand. The weaknesses, though, for just the straight payback, ignores time value of money, ignores cash flows, and both of them ignore cash flows after the payback. The example we looked at, the payback was between years 2 and 3, and it was a 3-year project, so there were no future cash flows. But maybe it was a 20-year project and went positive in 10 years, then we just simply stop. So wherever we go positive, we stop. We don't take into account any future cash flows. There's no relationship between a payback and investor wealth maximization. So, kind of like when I built that apartment complex, or when we built the apartment complex, and we had some investors in that project too. They all wanted to know how long was the payback period, even though it has no indicator about the future value of the project, or how much this project's really going to be worth over time. It just seems like it's human nature to want to ask that question. It makes me feel better if it's short, right? So that everybody wants to know the answer to that one. Okay, so in this example, then, it says to find Project P's NPV and IRR. This one, it says Project P has cash inflows in thousands of a -800, a +5, and then a -5. And it says to put that into your calculator, and using the 10% WACC, and NPV is negative, but the IRR is an error. And the answer is why. Unfortunately, IRR is not always a perfect method to use when you've got negative cash flows. It just can't handle that. The math doesn't work very well. And I'm not a mathematician, so I'm not going to get too deep into that. Okay. So we're going to get into some more details here about these. This multiple IR stuff, I am not really getting you on in the problems, test, or quizzes. So it's just there. I'm not going to cover that in much detail. I just don't think, I think it kind of just convolutes things. I just want you to be aware of it, but I'm not going to go into detail when we do this in your homework for points. Okay, so I'm going to end it right there. And I'm going to have another video that explains just how to use the Excel and do the calculations there.